In 1977, Warren Buffett wrote an essay for Fortune magazine called How Inflation Swindles the Equity Investor. In it, he argued that inflation is a far more devastating tax than anything any government has ever passed, because it has what he called a fantastic ability to simply consume capital, not shrink it, not slow it down, consume it. And the worst part, according to Buffett, is that most people don't even notice it happening. I'm Isiah from the Investor Centre, and today we're looking at what that actually means for anyone in the UK with money sitting in the average savings account. Because what Buffett was describing nearly 50 years ago in America hasn't gone away, and for UK savers right now, it might be more relevant than ever. Here's what's actually happening. According to the Office for National Statistics, UK consumer prices rose by 28% between 2020 and 2025. Food prices specifically went up by nearly 39% in that same window, according to the House of Commons Library. And if you zoom out further, a pound today buys roughly 46 pence worth of what it bought in the year 2000. That's not opinion, that's just what the raw data shows. Fidelity published a report early this year showing that UK savers lost 17.6 billion to inflation collectively in 2025 alone, because the average easy access savings rate was sitting well below the rate of inflation. So, for millions of people, the number in their bank account rose by a negligible amount, but what that number could actually buy was shrinking every single month. And that's the bit that catches ordinary people out. Your bank balance doesn't go down, so your savings feel safe. The FSCS protects up to £120,000 per person per institution, which means if your bank fails, your money is protected. But nothing protects it from losing value while it sits there. The word safe in this context means your balance is secure. It doesn't mean your purchasing power is secure, and those are two very different things. That's what Buffett was getting at. The swindle isn't that someone takes your money, it's that over time, your money is just worth less. So what can you actually do about it? Well, the first option isn't really a separate strategy at all. It's just doing what you're already doing, but doing it with more purpose. If you're going to keep your money in cash, and most people should keep some, then at the very least, make sure you shop around to be sure you're getting the best rates available. The difference between a high street default savings account and the best fixed rate deals on the market can be well over a percentage point, and over time, that gap compounds. It will rarely beat inflation on its own, but it will slow the erosion and shouldn't take too long to set up or move your money over from your old account. The downside is that there will likely be more rules about how and when you can withdraw your money, as many higher rate savings accounts are fixed term and come with early withdrawal penalties. The second option is one that doesn't come up as often in these conversations, and that's gold. Gold is the oldest store of value in human history, and it has a long track record as an inflation hedge. During the UK's last major inflation crisis in the 1970s, gold priced in sterling went from around £14 an ounce to over £300 in a decade. More recently, gold prices have risen around 200% between 2021 and early 2026. For UK investors specifically, Royal Mint coins like Sovereigns and Britannias are exempt from capital gains tax, which is a genuine advantage. Now, gold doesn't pay dividends and it doesn't generate income, so it's not really about growing your money, just trying to preserve it. But if the goal is to simply stop your wealth shrinking, it's worth understanding as an option. Historically, gold has often done its best when the economy is at its worst. The third option is the one I personally believe in the most, and that's a stocks and shares ISA. The ISA wrapper means any gains you make inside it are completely free from capital gains tax and income tax, which over the long term makes an enormous difference. It's worth understanding that there is currently a yearly £20,000 deposit limit when it comes to the tax-free status, which for most people shouldn't be a problem. Historically, diversified equity investments have been the most reliable way to outpace inflation over periods of 10 years or more. You don't need to be wealthy to use one, you don't need to pick individual stocks, and you can start with a relatively small amount. It carries more risk than cash, there's no question about that, but the risk of doing nothing carries its own cost, and that cost is the one most people never see on their savings account annual statement. Buffett wasn't saying never hold cash. He kept billions in reserve at Berkshire Hathaway for decades. What he was saying is that you should understand the price you pay for holding it. There is a real measurable cost to doing nothing with your money, and now you know what it looks like. This is not financial advice, it's just information. What you do with it is entirely your call. I'm Isiah from the Investor Centre, and I'll see you in the next one.